CapMan plc is a prominent Finnish private assets company publicly listed on Nasdaq Helsinki. 1. The company operates a distinct hybrid business model, which combines the stable, recurring revenue generated by its management company segment through management fees with the potentially high-impact yet inherently volatile performance returns derived from its investment company segment through realized investment returns and fair value changes in proprietary co-investments. The corporate strategy is highly focused on achieving significant operational scale, anchored by the ambitious objective to double its assets under management (AUM) to €10 billion by 2027. 3. This quantitative growth target is linked to a long-term financial goal of attaining a return on equity (ROE) averaging over 20%. 3. Furthermore, CapMan emphasizes becoming a leader in sustainability, integrating comprehensive ESG factors into its active value creation processes, aligning the business with its vision for the future society. Growth trajectory and strategic real assets focus. CapMan has made notable progress towards its AUM targets through both organic fundraising and strategic acquisition. As of September 30, 2025, AUM reached a record €7.1 billion, representing a substantial 17% growth since the beginning of the year, Euro 6.1 billion at 31 December 2024. 4. This expansion was specifically fueled by €560 million in new capital raised, supplemented by inorganic contributions. The strategic direction emphasizes a high concentration in real assets, including real estate, infrastructure, and natural capital, which collectively account for approximately 80% of total AUM. 7. This concentration is a deliberate strategy to secure long-term, predictable fee streams while mitigating exposure to the potentially greater cyclicality characteristic of traditional private equity buyouts. Over the past decade, CapMan has established a strong record, achieving a compound annual growth rate (CAGR) of 7.5% in AUM, providing a solid foundation for fee profit growth. Impact of strategic acquisitions, inorganic growth. Inorganic growth has been critical to the recent acceleration of CapMan's AUM. The acquisition of Dasos Capital, a specialized timberland and natural capital asset manager, was finalized in March 2024. This transaction was pivotal, establishing natural capital as a new, strategically important investment area, enhancing the company's ESG credentials and significantly promoting CapMan's vision for responsible private asset management. The Dasos acquisition was compensated through a hybrid structure comprising a €3 million cash payment and a directed share issue of 17,672,661 new CapMan shares, valued at €34.4 million on the transaction date. This share issue represented approximately 10% of CapMan's ownership. 9. A detailed assessment of this transaction indicates that the resulting equity dilution, while impacting the share count, is strategically justified. The immediate addition of long-term AUM and diversification into the natural capital space enhances the inherent stability of the management company's fee base. This choice reflects management's prioritization of achieving the ambitious 10 billion AUM goal and securing long-term recurring revenue over avoiding short-term impacts on the share structure. The inorganic expansion continued in 2025 with the acquisition of a majority stake in Caris Debt Investments AG, a German real estate debt specialist. This transaction closed on July 31, 2025, instantly boosting AUM by €640 million and establishing the new real asset debt segment. This activity, alongside the acquisition of Midstar Fastigheter AB's hotel portfolio by the CapMan Hotels II Fund, which added Euro 0.4 billion to AUM, demonstrates a consistent and effective deployment of capital toward the AUM growth objective. In-depth analysis of the income statement, volatility, stability, and normalized profitability. The analysis of CapMan's income statement reveals the inherent tension between the stability provided by management fees and the extreme variability introduced by carried interest and fair value adjustments. Revenue segmentation and fee income resilience. Fee income forms the essential foundation of CapMan's revenue base, stemming from long-term fund agreements which impart a high degree of predictability. During the first 9 months of 2025, 1-9-2025, fee income demonstrated robust organic growth of 6% year-over-year, reaching MEU 42.2 compared to MEU 39.9 in the corresponding period of 2024. 6. This growth is directly attributable to the expanding AUM base resulting from both successful capital raising and the integration of new businesses. The overall group revenue for 1-9-2025 was MEU 42.5, which represented a marginal decrease from MEU 43.7 recorded in the previous year. 6. This reduction is not indicative of weakness in the core asset management business, but is explained by the divestment of the CAP service business, which was classified and reported as a discontinued operation, necessitating the restatement of comparative periods. 7. The momentum in core continuing operations remains clearly positive, driven by fee income growth. The challenge of performance fees and fair value changes. The investment company's results introduce considerable fluctuation. This was vividly demonstrated in the 1-9-25 period, where net carried interest income, dependent on realized fund exits, saw a dramatic 93% decline, generating only MEU 0.3 compared to MEU 3.8 in the previous year. 4. This decline underscores the highly cyclical and difficult to predict nature of performance fees in the private assets industry. However, the operating result was significantly bolstered by a strong recovery in the fair value changes on CapMan's proprietary co-investments. These positive changes contributed MEU 12.4 in Q3 2025, compensating for negative contributions experienced in the prior year period. 4. The profound volatility of investment returns is further evident in historical results. The 2023 operating profit was constrained to MEU 4.7, primarily due to negative fair value changes of MEU -6.1, whereas the 2024 profit surged to 73.5 million, largely due to major non-cash valuation adjustments. A closer inspection of operational profitability, specifically the fee profit metric, reveals an important dynamic. Despite the 6% increase in fee income in 1-9-25, fee profit itself remains static at MEU 6.5. 6. This lack of flow-through indicates that internal operational costs, likely driven by significant non-recurring expenditures related to the integration of Dasos and Keris, or necessary upfront investments in human capital and infrastructure to support upcoming flagship fundraisings, such as European Forest Fund 4 and Infrafund preparations, have absorbed the incremental revenue generated. This cost pressure temporarily masks the underlying operating leverage potential inherent in the scaling AUM base. Earnings and forward outlook. Given the extreme fluctuations in performance fees and fair value adjustments, comparable operating profit, comparable EBIT, offers the most reliable metric for assessing core operational performance. This metric demonstrated significant health in 1-9-2025, increasing by 46% to MEUR 19.1, up from MEUR 13.1 in the comparative period. 6. This improvement reflects the stabilizing effect of fee growth combined with the underlying positive trend captured in investment returns. Correspondingly, bottom-line profitability improved sharply, with diluted earnings per share jumping from 0.9 cents to 5.5 cents year-over-year, 1-9-2025. The more representative comparable diluted EPS rose from 1.9 cents to 6.4 cents. Looking ahead, analyst consensus forecasts robust financial expansion, projecting adjusted EBIT to climb from MEUR 27.3 in 2025 to MEUR 46.2 by 2027 reflecting the anticipated full-year benefits of strategic acquisitions and the compounding effect of successful fundraising. Analysis of the balance sheet, capital resilience and investment allocation. CapMan's balance sheet confirms a strong foundation of capital, which is critical for supporting its ambitious growth agenda and insulating the company from private market volatility. Solvency and capital structure. The company maintains a high level of solvency, with total equity amounting to MEUR 190.14 as of September 30, 2025. 4. The equity ratio stood at 59.3% in Q3 2025, significantly exceeding the company's long-term objective of achieving a ratio greater than 50%. 4. CapMan's leverage is conservative. While total gross debt was approximately MEUR 102.23 in Q3 2025-13, the net debt position is modest, with interest-bearing net debt standing at MEUR 51.8. This is supported by substantial liquidity, comprising cash and short-term financial assets totaling MEUR 54.0. 4. The long-term debt consists of sustainability-linked unsecured senior bonds, Euro 40 million maturing in 2027 and Euro 60 million maturing in 2029. The strong equity ratio, 59.3%, and conservative net leverage are not simply signs of cautious management. They represent a strategic financial asset. This capital strength serves as an internal buffer, shielding CapMan from the temporary negative impacts of volatile investment returns. Furthermore, this robust financial capacity provides the necessary flexibility, or dry powder, to execute future accretive acquisitions required to meet the $10 billion AUM goal, particularly in operating environments where external credit or capital raises might be challenging. Own balance sheet investments, co-investments, and valuation. CapMan's strategy involves systematically committing its own capital alongside fund investors, typically leveraging these co-investments using 50% debt to enhance the potential return on equity. These co-investments, with a fair value of approximately 185 million euros as of Q3 2025, contribute to results through both realized exit proceeds and non-cash fair value changes. The valuation of these predominantly unlisted investments adheres strictly to recognized industry standards, specifically the International Private Equity and Venture Capital Valuation Guidelines, IPEVG. 14. CapMan primarily employs two methodologies: the earnings multiple valuation technique, which derives value from the multiples of comparable publicly traded peers, and the discounted cash flow, DCF. Crucially, CapMan applies a consistent liquidity discount to the peer group multiples used for its unlisted holdings. This conservative valuation practice acknowledges the inherent illiquidity of private assets compared to publicly traded stocks, providing a more realistic and disciplined valuation floor for the proprietary investment portfolio, thereby mitigating the risk of potentially inflated fair value accounting. Cash flow statement analysis, liquidity generation, and capital deployment. The cash flow statement is essential for distinguishing true cash generation from accounting profit, particularly given the magnitude of non-cash fair value adjustments impacting CapMan's income statement. A. Cash flow from operating activities, CFO, and working capital dynamics. A key structural feature of CapMan's financials is the significant divergence between reported net income and cash flow from operating activities. For example, 2024 saw a high reported net income of 73.5 million euros, contrasted sharply with a modest CFO of only 4.1 million euros, down from 5 million in 2023. This disparity is largely attributed to the treatment of large non-cash adjustments, specifically the positive fair value changes that substantially inflate net income but are eliminated when calculating CFO. Furthermore, working capital dynamics play a role. Under accrual accounting principles, revenue from management fees is recognized when earned, leading to the creation of accounts receivable even before the physical cash is received. This increase in current non-interest-bearing receivables reduces the immediate operating cash flow. The analysis of the consistently low CFO relative to high reported profit confirms the need for investors to rely on the sustainable portion of the business, primarily stable fee profit and realized capital distributions from investments, when assessing the company's ongoing capacity for shareholder distributions and internal capital expenditures rather than volatile, non-cash adjusted net income figures. Cash flow from investing and financing activities. Cash flow from investing activities, CFI, reflects CapMan's strategic capital deployment. CFI saw a major outflow of 59.0 million in 2024, a significant increase from zero in 2023. 9. This expenditure underscores aggressive strategic growth, funding both the cash element of the Dawson's acquisition and ongoing commitments to proprietary co-investments, positioning capital for future returns. Cash flow from financing activities, CFF, details funding and shareholder remuneration. Major outflows included substantial payments for dividends and return of capital amounting to €18.0 million in 2024 and €27.1 million in 2023. A notable inflow in 2024 was the €34.4 million generated through the directed share issue related to the Dassault business combination. Dividend Safety and Distribution Sustainability Assessment. CapMan's distribution strategy is clearly defined, prioritizing distributions that are sustainable and that are structured to grow over time. A. Distribution policy specifics. The formal policy mandates distributing at least 70% of the group's profit attributable to equity holders. Crucially, this calculation explicitly excludes the impact of volatile fair value changes. 3. This exclusion correctly focuses the distribution analysis on realized, recurring income streams. The policy also allows for additional payouts derived from investment operations, provided that cash requirements for future proprietary investments are considered. B. Coverage analysis of recent distributions. The total dividend distribution declared for the 2024 financial year was 0.14 per share, authorized in September 2025. 6. When evaluated against core profitability metrics, the 2024 payout of 0.14 per share appears high relative to the normalized earnings capacity, as suggested by the comparable diluted EPS, which reached 6.4 cents for the 1-9-2025 period. 4. This structural feature, a high payout ratio relative to normalized EPS, implies a strong commitment by management to the stated mandate of paying sustainable distributions even when core operating profits or realized exits are temporarily subdued. This sustained payout, despite lower recent realization activity, necessitates drawing on the company's financial reserves. The exceptional financial strength, characterized by the 59.3% equity ratio, allows CapMan to strategically deploy retained earnings as a buffer, ensuring the distribution expectation is met. This behavior reflects a management choice to maintain shareholder confidence by prioritizing distribution stability, leveraging the balance sheet to bridge temporary gaps until exit activity and resultant realized capital gains normalize. Current valuation and sum of the parts SOT framework. Due to the dual nature of CapMan's operations, a rigorous valuation must employ a conceptual SOT framework. This method separates the stable fee-generating management company from the fair value of the proprietary investment company, providing a holistic view of enterprise value. B. Forward-looking growth and multiples benchmarking. The valuation is supported by compelling analyst growth forecasts. Revenue is projected to expand significantly from MEUR 61.0 2025E to MEUR 84.6 2027E, while adjusted EBIT is forecast to rise from MEUR 27.3 to MEUR 46.2 over the same period. The private assets and asset management sector frequently commands premium valuation multiples driven by the scarcity of recurring high-margin fee revenue and the exposure to high-growth private markets. 19. The global median M&A EV to EBITDA multiple stood at 9.3x as of mid-2025, confirming strong pricing in the sector. CapMan, benefiting from its specialized focus on the Nordic region and its strategic weight in real assets, is positioned to realize similar sector multiples on its stable fee business. Based on anticipated growth and peer benchmarking, the analyst consensus currently places CapMan's fair value in the range of 1.6 to €2 per share. C. Investment company value, NAV, and return on equity, ROE. The investment company's value is approximated by the fair value of its co-investments, which totaled approximately €185 million in Q3 2025, closely aligning with the reported total equity of MEUR 190.1. 13. A critical observation is the performance gap in profitability metrics. The comparable return on equity, ROE, was 9.1% in Q3 2025 compared to 9.7% in Q3 2024, falling significantly below the company's long-term financial target of averaging over 20%. The pronounced shortfall between the current ROE, 9.1%, and the targeted 20% implies that CapMan's proprietary invested capital is significantly under-earning relative to the company's structural capabilities and management's expectations. Bridging this gap is essential for generating substantial shareholder returns and justifying higher valuations on the equity component. Achieving the targeted ROE requires a major acceleration in realized investment returns, converting the accumulated positive fair value changes into realized carried interest income and capital gains. This discrepancy represents a latent value creation opportunity, as successful execution would drive the ROE metric toward the target and warrant a higher PB multiple on the company's substantial equity base. Summary of risks and conclusions. CapMan presents an equity investment case predicated on successful execution of its AUM growth strategy and leveraging its robust financial structure. A. Key risks and sensitivities. Macroeconomic and valuation sensitivity. CapMan's profitability is structurally linked to capital markets. Since the valuation of unlisted investments relies heavily on peer group multiples, fluctuations in public equity markets directly influence the fair value changes reported on CapMan's income statement and balance sheet. Fundraising execution risk. Failure or delays in closing flagship funds, such as the postponement of Nordic Real Estate 4 to 2026, directly jeopardizes the 10 billion AUM target and consequently the projected growth rate of fee income. Realization dependence. Despite the policy of excluding fair value changes from the distribution calculation, achieving the ambitious 20% ROE target relies fundamentally on the highly volatile realization of carried interest, as evidenced by the dramatic 93% drop in this revenue stream in 1-9-2025. Investment conclusion. CapMan plc is successfully transforming into a diversified, real asset-focused private asset manager, supported by strategically accretive acquisitions like Dasos and Ceres. The core investment case is secured by the structural stability of the management company segment, demonstrated by 6% fee income growth, and underpinned by a conservative and resilient balance sheet, 59.3% equity ratio. While the current comparable profitability, 9.1% ROE, lags the 20% target, the forward-looking valuation is supported by strong analyst consensus projecting significant adjusted EBIT growth through 2027. The company's robust balance sheet provides the financial buffer required to maintain its sustainable distribution policy during periods of lower realization activity. The long-term investment opportunity lies in management's ability to convert to growing AUM into tangible margin expansion and accelerate realized investment returns, thereby closing the existing ROE gap and unlocking further embedded value in the investment company.